Good morning, good afternoon, good evening. If you're watching this on replay, how are we all doing? It's Sanjay here. I have got my monthly mortgage update. We do this every last Friday of the month where we just dig deep into what's going on in the mortgage world. I've got a special guest and a good friend of mine. Second time in a row, Dave. There you go. You're still my friend. Don't worry. I've got Uncle Dave here. How you doing, sir?
I'm very good, thanks, Sanjay. Very good indeed. Thanks for having me today.
Good, good. And we've got another special guest as well today joining us on a monthly mortgage update, Mr. Ian Macbeth. How are you doing, sir?
I'm very good. It's Friday, bank holiday weekend, early start this morning. Looking forward to getting stuck into this chat and having a good chat with you guys.
Absolutely, absolutely. Right, let's just get stuck in then, shall we? It's Friday, it's end of the month. We're 4 months into the year. I can't believe it already. That's crazy. Where has the time gone? But hey ho. Right, Ian, let's just go to you first. Dave, don't worry. We've got lots of mortgage questions coming up.
I'm sure you have.
Ian, give us your sentiment on what the hell is going on with the market at the moment, just as a quick summary, just for people and buyers and sellers that are watching.
Quick summary. We've got everyone that's under offer at the moment that are heading towards that stamp duty holiday. So I would imagine that's a hectic time for people. I think we're seeing search packs come back quicker than they were a few months ago. So everyone's got some confidence and positivity there, which is great. Solicitors are still very busy mind, and there's a lot of them out there that are now really struggling for updates. So we've got to all support each other in our power teams to make sure the transactions go through. And then on the flip, people looking for properties at the moment, it comes on, it goes, it comes on, it goes, and then it goes up in value. So that's pretty much the theme of the market is, I think we all spoke at the start of the year about, is the market about to boom, and is the market about to turn into a first-time buyer dominant market? And the answer is yes, 4 months down the line. So yeah, 100%. Prices are pushing up, stock is lower, demand is up. I think there's some statistics that I'm sure you've got somewhere, Sanjay, on the demand levels, but I would say confidence is high as it's been since I can remember for many, many years in the property market at the moment.
100%. I feel exactly the same. Guys, if you're watching this, I know there's a few people that's logged in this morning, so thank you for joining us. Make sure you grab a coffee and get involved. Please feel free to pop your question. Anything mortgage related, anything property related, we're going to cover it today. If we don't, we will come back to you after the live stream. Pop it in the comments below. Right, Dave, big topic at the moment, rates. Right. What is going on with the rates? Why are they so low all of a sudden? I know it's been a gradual thing. I mean, we were having this probably conversation 6 months ago, 7 months ago, October-wise. Completely different ball game, right? What's going on right now that buyers can benefit from?
So, again, it comes down to loan to value, Sanjay. If you're up at those higher loan to values, 80, 85%, 90, even 95 now, I'm pleased to say, low isn't the right word. You're still talking 2, 3, 4%. But anything below 80%, say 75 down to 60, you're right. They haven't been this low for a long time. Market leading rate out there at the moment for a remortgage, 1.05 2-year fixed. Santander at the moment, that's cheap. That is cheap borrowing. You've got to have actually that's I think it's 70% loan to value. It's a brilliant rate. I think what's happening is the lenders are still trying to compete for business. They've got to do it responsibly. So they're competing in the lower loan to value bracket. And that has got quite ferocious. They really are cutting rates to try and get the business there. The higher end of the loan to value, they're still regulated heavily. They've still got to be sensible, lending sensibly up at the higher loan to value brackets. They haven't got a lot of wiggle room there. So everything's happening down at the lower end of the game there.
Yeah. Absolutely. I mean, I'm speaking to a lot of people. I actually spoke to a buyer the other day. What's your thoughts on this? They said they had they were hoping for a 15% deposit to 85% loan to value. And they said if they went to 16% deposit, their rate and products completely changed. They were getting a whole lot better deal. What's your thoughts on that?
If I'm really honest, that surprises me. So if you'd said that, so the cutoff is 85%. So anything between 80 and 85, so anything between a 15 and a 20% deposit is going to be the same set of interest rates. So 15%, 16%, you should be getting the same interest rates. If you'd said to me 14% to 16%, yes, big difference because you're either side of that 85% banding there. But from what you just said there, it does surprise me. But there is a big difference with only a small amount of change in the deposits. It just depends on what side of the loan to value bracket you are. 85%, 90%. So you've got to be either side of that to actually see a massive difference there.
Interesting. That's good to know. No, definitely. It's good to know. And then talk to us about, obviously, the 5% deposits. They've obviously been coming back in full force. Have you been doing a lot of them? Have you seen an increase in them yourself?
We've had a lot of conversations about them, not so much uptake on them. The way it's marketed, the way the press will have you believe is there is this mortgage guarantee out there to give you a mortgage with a 5% deposit, 95% loan to value. The guarantee is for the lender. The banks are guaranteeing that if the lender has to repossess and can't get the money back when they sell the house, they will bridge any difference in losses there. So it's not a guarantee that somebody's going to get a mortgage, which a lot of people will believe. They're thinking, I'm going to be guaranteed a mortgage, and a 5% deposit. That's amazing. Unfortunately, it's not quite that good. You've still got to have the income to get potentially a bigger mortgage because you've got a lower deposit. And that doesn't always stack up for people. But that said, where the people have got the good incomes and they've got just a little bit of deposit, it's a great offering. It really is good.
Yeah, Ian, what's your thoughts on that?
Yeah, I'm just wondering whether there's any sign of leasehold mortgages being an option on these 95s yet. That was the thing that I was going to ask you.
So, leasehold themselves, excuse me. It's more flats, leaseholds, share of freeholds, those sort of things. Flats are the problem. Certainly new build. And it's always been the same. It's not just something that's new now. Getting a 90% mortgage on a flat, especially new build, is challenging. 95% on a flat or a new build particularly is almost impossible, and it has been for many, many years. So to be honest, Ian, I don't really see that changing because it's a historic problem. It's not something that's created by the pandemic.
I think it's sensible, isn't it? It's the safe way of doing it. I understand why. Most people I'm viewing with at the moment, I don't know if you're finding the same, Sanjay, is sort of 10% and upwards on the deposits, I think, at the moment, because the rates at 10% are pretty special when you compare them against this time last year. I don't know what the difference is, Dave, off the top of your head, but it's pretty significant.
Best out there, 10%. Last time I looked, 2.99 with Coventry. So not bad. I mean, you can go back to probably the start of 2020 when they were the 1.79, 1.89s, but that was just crazy low borrowing. That was crazy low. 2 years back, 3 years back, exactly like you say, Ian, we're back to that sort of level now. And I think that's where it should be. There is a risk there with the 10% deposit. What I don't like, particularly with the 5%, is some banks are trying to tie you in for 5 years. And I think that's a little bit naughty. I can understand why they do it, security for them. But if you've got a 4.5% interest rate, I struggle to say that's the right advice for someone to tie in at that level for 5 whole years. It's a big commitment.
But that's not for all 5% deposits, is it now?
No, there is a few options for 2 years out there now, which is exactly what we need. So they're starting to see sense.
And are the rates still the same for the 2 year fixed?
You're talking 4% really, yeah. 95% loan to value.
Yeah.
Around that region.
Right. Okay, fine. One question I got asked yesterday from one of my buyers is if they don't look or they don't find something now in this sort of cycle, this period of the year we're in where prices are really high and things are selling quickly, even things are selling off market, would it be better for them to wait until sort of 6-7 months down the line or even till this time next year? And they asked the question, do you think rates will change? Do you think they'll go back up? So they'll be actually worse off because they're sort of imbalancing because they'll be paying more on their mortgage, but then saving now and then pay more on the price, but then saving on the price. It's sort of a backwards way. What's your thoughts on that?
Well, you guys have probably got your finger on the pulse as far as the actual prices are concerned, but I agree with what
Ian definitely has.
Yeah, at the start of the call there, Ian, you mentioned that property prices have been climbing. Everybody's seen that. Are we at a peak? Is it going to start coming down? That's the concerns, and that's the concerns first-time buyers particularly are right to be thinking about. I don't think interest rates are going to start climbing up again. When the Bank of England brought the base rate down, we didn't see an immediate knee-jerk reaction where all the rates come tumbling down. In fact, they've gone up since that point. So it doesn't make sense just because the base rate goes back up to quarter, half, 0.75% that rates are going to climb upwards as well. I don't think that's going to happen. Actually, I think rates are going to probably plateau, stay where they are now. And if you can see house prices coming down, then there is a good argument for people to hold fire and just see what happens in the market because of that. Just quickly, on those 95%ers again, this is where it doesn't sit particularly well for me. If you're going to tie yourself in for a long time at a high interest rate, if your property value does come down, when you're out of that rate, you could be in negative equity there because you've only got a 5% deposit to start with. So if your house price has dropped, you could be in trouble, and we might not be having a particularly pleasant conversation at the end of your fixed term. So although those 95s are out there, it's got to be right for that individual. There's a lot of big conversation to be had about it.
So basically, moral of the story with the 5% deposits is if you get to a 10% deposit, banker, mum and dad or whoever, get to a 10%, you'll be a lot better off.
Absolutely, Sanjay. Yeah, I think that's definitely, you've got to try and do that no matter what.
Nice. What's your thoughts on that, Ian?
Yeah, I think if people are in the fortunate position where they can borrow some money from the bank of mum and dad, and for the bank of mum and dad, if you look at a remortgage or a top up, say mum and dad lend 30k, for example, to someone, for them to do that, they're probably going to be on a low loan to value. So they're probably going to be, 60, 50% equity, whatever it may be in their house. That's peanuts, really, that 30%. And when you look at car finance, or you look at, credit cards or loans out there, 5, 6, 7%, it just makes sense for someone to do it that way. And even if you pay the bank of mum and dad the difference that they're doing on their sort of small remortgage, it gets more people moving. I think on the 5%, Sanjay, the thing for me is, if you're looking at 2 years and 5% and you're renting property at the moment, it's a bum fight out there to find a property to rent. It's very expensive. If you can do it for the 4% or, even 4.5%, whatever that 5% deposit deal is, as long as you're sensible and shrewd with your purchase, I believe the next 2 years we'll see prices fairly significantly increase, definitely for the next 18 months. And I think the UK is about to run out of stock. I think it's about to run out of property because rates keep dropping. People have done the move because of stamp duty quicker than they anticipated. So we've had 2 years worth of people moving in the last 9 months. So less comes on, more people move, and the scale will do that. Whether it's a false economy or not, I don't know, but I can't see the government changing interest rates anytime soon because they want more money in the economy. So I think we are seeing the next 18 months, 2 years of price increases, high demand, low stock levels is my view on it.
That's some quite big statements you just pulled there. It'll be interesting to see what happens in 6, 12 months.
I'm going to watch that space, definitely.
I mean, you know what? It's a logical way of thinking about it, because if you're just following the trends of what's happening at the moment and what's happened over the last 6 months alone, then, I agree with you. I actually agree with you. But on the flip side of this, when we first went sort of out of last year, COVID, what are we, September, October, sort of the end of the summer, the million plus property market had also massily increased in sales going through as well. I've been watching it closely, and the million plus property market, and a lot of those sales are off market, the ones that are million plus, because you can see them going through completions. I was reading a report the other day, there was almost like a 20% increase in sales in the million plus property market too, which was very interesting to me, because obviously with the stamp duty, it's more focused around the lower end of the market and up to 500. So what's your thoughts on that, Ian?
Well, what's interesting, talking about trends, data and analysis, is in March, the government reported, I think it was March or February, one month this year, that they had the 5th highest ever stamp duty take on record. So we're in the middle of a stamp duty holiday, and the government took more stamp duty tax on the 5th level, the 5th highest month ever on record in the UK. So to answer what you said about the £1 million market, the £500 plus market, actually by taking a stamp duty holiday up to 500k has brought in more tax than it has done previously, bar 4 other months. That's quite a powerful statement, because what it shows is A, there's a reform for stamp duty potentially that could happen, and B, there's a lot of people moving 500k and upwards. So my thoughts are on it. It's a statement that might actually mean that it shows what me and Mike talk about often, is stamp duty is something that stops people moving. And if the government benefit or the economy benefits from somewhere around 30k per transaction on average to the economy, then maybe the reform of stamp duty comes next year or the following year or around the next election as someone's political statement to say stamp duty gets abolished under 500k, or £1,000 per case has been rumoured about under 500k. So people have got the money to do it. So, let's make a movement. Let's make that happen. Who's got the mobile number for Boris? Let's give him a WhatsApp.
I mean, on WhatsApp. We've got him in a WhatsApp group. WhatsApp.
Sanjay, on that, do you think that's potentially people moving out of London into the suburbs? The people buying those £1 million houses? There's been quite a shift there, hasn't there?
I've got a video coming out on this soon, actually, because I've seen a massive trend since September last year with buyer registration has massively increased. For me personally, Ian, you can probably comment on this or agree as well, London buyers coming out into the home county areas has massively increased.
Yeah.
I think we're talking 60% almost of my buyers that are in a London sort of borough and surroundings moving into the home counties. And also on the flip side of this, there's also been a massive shift from home county residents moving down by coastlines, Bournemouth, Devon, Newquay, all of these places, Cornwall. So there's been a massive shift. But at the same time, I did read a report the other day that London prices have actually started to increase again recently, very recently. So, who knows if that's going to keep going? I don't know. Ian, what's your thoughts? Have you had a lot of London buyers come out in our areas?
Well, yeah, same as you. London buyers, London tenants, everyone kind of moving out of London to home counties because they're going to be probably needing that extra work from home space. If you own a flat in London for 700 grand, 750 grand, and it's a 2-bed, 2-bath with 1 reception room, you take that over here and buy your 4-bed detached. You got your home office, you got your ensuite, you got your spare room for when your family come and stay. It's a different lifestyle. And if you're not having to go to London 5 days a week and maybe doing it once a week, well, you don't mind jumping on that train from Reading to Waterloo for 90 minutes. So that definitely I've seen. Same as you, people relocating out of here to the New Forest or wherever it may be. And then I think with the London demand, you probably find there's a lot of tenants that are in London on high salaries that are now looking to purchase because the 90% loan to values are back that weren't there last year. So, they weren't able to do that as a tenant, but if they've saved 10%, they can now. And then you've also got people coming in from foreign countries as well. So, there's a lot of money with Chinese investment, Hong Kong nationals coming in. So, they typically home in towards London as their first port of call. So the whole cycle of things at the moment for the property market is a bit crazy. I've done it since 2003. It's as crazy as I've seen since 2006. That's how active I think it is at the moment.
Madness. Okay, Dave. Just on the flip side, Dave, I was speaking to a buyer the other day. Actually, speaking to a couple of buyers recently. 50% loan to values. What are we talking? Are they popular at the moment? What kind of rates are we getting? Because I'm actually finding quite a few sellers of mine and clients have actually got quite a lot of equity in their property. So they're actually looking to still hold that equity and still purchase, but keep the loan to value quite low or low as possible.
Yeah, 50% loan to value. If you've got that much equity, that much deposit, you're in a great position. Anything really below 60% loan to value, you're going to be getting the majority of the lenders' very best interest rates. There are a couple that have preferential rates at 50 or less. Most of them are 60, sub 60. So if you're there, like I said earlier, 1.05, 5-year fixes are out there at, I think, 1.19. Don't commit me to these rates; they change all the time. But that's what you can get right now. So grab it. It's really cheap money. Definitely. It's a good loan to value bracket to be in.
And let's talk. Just I just want to touch on before we finish about investors, landlords. Where are they? What's going on? Are they buying in? What are your thoughts on this? Have you seen an increase in them in the last 6-12 months, or have you seen a decrease, or where do you think they sit on this?
I mean, I've definitely seen an increase in demand. Dave will probably be able to answer the question on the percentage shift for let to buys and buy to lets. I think let to buys were really common. I think with the stamp duty holiday, a lot of people were going, right, let's keep it and buy and, you know, put the stamp duty tax in the bank as extra deposit. But why wouldn't you? There's no money in the banks at the moment. You know, stocks and shares are up, down, all over the place. You know, who knows what's going on. And if you don't want to start investing in cryptocurrency, then your safe bet basically is to put it in property at the moment. You mentioned 50-50s on the loan to values. If you can get a 1% interest rate and pull out 50, 60, 70 grand, why wouldn't you go invest in a property, especially 100%. If prices are on the boom? So yeah, why wouldn't you? I ask anyone to come back on a comment of that. What is the reasons not to invest at the moment? Because I don't think there are that many. Are you seeing that, Dave? Sorry, Sandra.
Sorry, just quickly. Well, there's a question that I get, and I had this recently: is it a good time now to invest, or is this a boom, and is it going to crash later on this year? And am I going to potentially lose money, even if you're buying at sort of market value or just below market value? That was the question I keep getting from an investor perspective.
So there's things to look at what you want to buy. You need to buy something that if prices stay the same, which they won't, you know, and this is recorded, so you can come back and shoot me if I'm wrong, but the prices won't stay the same. They will go up for this year because of supply and demand. It's very simple economics. But if they didn't, buy something as a buy to let or as a build, you know, refurb, refinance project that's going to be a safe bet. And the trends at the moment are garages to office conversions. If you buy a garage, convert it into an office or another bedroom, it will go up in value. Therefore, you've bought a safe investment. Buy properties that have got slightly larger than average gardens and put a self-contained home office in the back garden. Look at properties where you could go from a 2-bedroom over the garage into a 3-bedroom because it will be worth more. Don't go crazy on your spend. Make sure that if you are going to spend X amount of money, you talk to one of us to check that the value is worth doing that. But if you buy sensible assets at the moment, then you're absolutely fine. So it comes down to the property. And that's where you've got to kind of talk to people like us that are landlords that have done property investment, that understand buy this type of property because it's going to be worth X in 2 years' time when you've done the work. Don't just go out there buying things that you're emotionally connected to. You have to look at it as an economic, non-emotional transaction.
Dave?
No, I completely agree. It's a great time, and you've got to be sensible about the property. You've got to talk to the experts. But as far as the borrowing's concerned, like we've said in this whole conversation, it's cheap lending at the moment if you're in the right loan to value brackets. So you can keep some of your deposit back. You can afford to do those renovations you were just talking about there, Ian, and still buy that perfect property to make it a worthwhile investment. So it is a great time for all of this to start to be happening out there at the moment, I think.
100%. Cool. Well, look, appreciate it, guys. Just a note on buyer activity. Just want to finish off because there's obviously a lot of conversation. A lot of buyers I speak to are missing out on properties. And we're talking like first-time buyers, nothing to sell, buyers and rented, mortgage ready to go, like proceedable, willing to buy, willing to offer there. And then if they find the right thing, I was with a buyer yesterday and they said this is the first property they've viewed. And I was like, how long have you been looking? They were like, probably about 3 weeks. So they were like, every time we inquire, we're either a day too late or we call in the afternoon and it's gone in the morning. So just a note to buyers and just a bit of advice, especially for us, like for the way we do things at Avocado Property, we launch all of our properties 2, 3, 4, 5 days before it even hits the market, hits Rightmove and the portals and Zoopla. So you have a way of getting first-hand to these properties that are selling in 2-3 days at the moment, especially the mid-range of 2-3 bedrooms. And I'm sure, Ian, you're a massive advocate for this. Like our Beat the Portals video, we do get a lot of messages off it at the moment. We are getting responses and are booking in viewings before it's hitting the portal. So if anyone's interested in that, please do keep following us on all of our social media. You will find our stuff and you will be able to get in. Please do not miss out, because I know as a first-time buyer, I've got a massive empathetic side to first-time buyers. It is hard. It's new. It's exciting. It's nerve-wracking. It can be tough. But at the same time, you've got to be on it. If you're in there, you've got every chance of getting a property.
Sanjay, on that, what I'm saying to all my first-time buyers is get yourself prepared with the mortgage, because so many people come to me and say, I've found a house, can I get a decision in principle? I think that's the wrong way around. Let's get you an agreement in principle. Let's give you that confidence the bank will give you the money. And tell me if I'm wrong, guys, but will that make them a more attractive buyer if they come to you with an AIP in their hand before they start making offers? That's kind of the advice I'm generally giving. But
it makes them a buyer. Without it, they are not a buyer.
They're not validated by the bank.
Yeah, because if you get 12 inquiries on one property, you're not going to book 12 people into that property. You need to check timescales, finances. And if someone says, no, I don't have a mortgage in principle, and I've just been looking on Google, you're not viewing the house.
No.
It's that cutthroat. You're not viewing it because you're a non-proceedable client. And I know it sounds harsh, but do the prep work first, because time is important and you have to put yourself in that power position. And if you don't know what you can afford, then you're wasting everyone's time. And at the moment with the pandemic, it's not the safe thing to do either.
No, exactly. I think, I speak to, this goes to buyers and sellers that are potentially looking to sell and buy themselves. Sort your finances out first. That's the very, very first port of call. I speak to numerous amounts of buyers who call in and inquire about property and have done nothing with finance. So it is important, more important. So I've done it many times when I've been purchasing. First thing I do is call Uncle Dave. literally call Uncle Dave.
We talk a lot, don't we, Sanjay? Yeah.
We do. You're on my speed dial. Both of you are. There you go. A little Friday.
I think first-time buyers and buyers in general are a little reluctant to get that decision in principle. Maybe they're concerned about the credit searches and this, that, and the other. But the way it works nowadays with soft searches, soft footprints, it really doesn't impact your credit score that much. There is no reason not to get the agreement in principle, get confirmation from that bank before you even start looking at properties on Rightmove or wherever you're going to go. It's common sense. There's no reason not to.
I mean, the reality is that when I've got a seller, say if I've got a new property coming in the market and it gets a load of interest, let's just say got 10 inquiries that come in, and I've got three buyers that said, oh yeah, we haven't looked into finances yet. And then I've got the other 7 who said, we've got finances going. Here's my mortgage in principle. This is what I can afford up to. This is my deposit, etc., etc. If I go to my seller, my client, the owner of this property, say, I've got 10 inquiries on your property. 3 of them haven't got their finances. The other 7 are ready to go. Where does that sit with you? So as a buyer, you have to be ready. You have to be ready to buy, especially in this market. And in any market, in fact, because as Ian said, you're a non-proceedable buyer effectively. And that's just no help to anyone, especially to yourself. You don't want to be wasting time. Last thing you want to do. So, any final words, Ian?
No, this subject we could talk for a whole nother half hour on, but I just think property market confidence is out there, but as agents that are protecting our clients, our vendors, they're the ones that pay our fees. We need buyer confidence, and buyer confidence comes from an AIP, an agreement in principle, knowing that you need solicitors and maybe you've got 2 that you're talking to, you're nearly ready to get instructed on that, having your ID ready to send over to us, and knowing what you want. A common question that we often ask people is, what do you want, what area, and what timescales are you looking towards? So it's a bit of advice to the buyers out there. If you call up and say, I'd like to view that house, well, what are you after? I'm looking for a 3-bed in a 15-mile radius of Reading. You've got to narrow down what you're after. I had showed someone yesterday that lives in the street and has sold a 2-bed masonette for the 3-bed house they were viewing last night. They don't even want to be 5 streets down. They want to be in that area because their kids go to school. That's a perfect buyer for that property because they know what they want. So we need buyer confidence as well as market confidence to make sure that we can get the right buyer for the right house, basically, and inevitably keep the vendor happy. So keep us confident in the buyers by doing your prep work, like Dave says. That's probably how I would sum it up.
Yeah.
Dave, any final words?
Well, I echo what Ian's saying there, to be honest. From my point of view, yes, the agreement in principle is important, but just having a conversation with a mortgage advisor, an expert, it opens up your eyes to so many things that first-time buyers might not have even thought about. Hidden costs, solicitors, difference between freehold, leasehold, all of these sort of things is a conversation that we would guide you through from very start to finish. So when they actually come and talk to you guys, they're fully educated about exactly what they want, what they can afford, what that's going to cost them. And that then narrows down their search, ready to talk to you, the estate agents, about, right, this is what I want. Go and find it for me. So we are helping them prepare for the conversation you just talked about there, Ian, basically. And it's priceless. It really does. I was, sorry to bang on, I was quite surprised. I did a bit of a market research. And asked, what's important to my customers? I thought finding the best rate, getting the most amount of money. Everybody said the customer journey, how you hold our hand from start to finish. That's what's most important to them. And I think us, you guys, we all do that united. And it leads to a very, very happy transaction at the end of it. That's my opinion.
Yeah, it's the power team, right? You've got to have a power team. But Andy in a power position. That's what I say. Just a quick one. Andy said, as things have evolved, we did kind of answer this earlier. As things have evolved over recent weeks, months, what's everyone's view towards the 5% mortgages? Good news or a potential banana skin? Well, we kind of answered that earlier, so I hope that was okay, Andy. Thank you for your question. Right. That's our monthly mortgage update. We are going to be in the month of May tomorrow, my birthday month. We do these every last Friday of the month. Please do check in. If you've got any questions, fire me or Dave or Ian. And we'll come back to you as soon as we can. But thank you for watching. Appreciate it. Cheers, guys. Happy Friday. Enjoy your weekend. Bank holiday weekend, actually.
Thanks for having me on.
Thanks, everybody.
Take care. Bye-bye.
Thank you.